Something extraordinary has happened in the silver market, and if you own silver or you've been thinking about it, what I'm about to show you could change everything about how you're positioned right now. Let me set the scene for you. Silver hit a price that many people said would never happen in their lifetimes. It cracked $100 an ounce. Think about that, $100. After sitting below $20 just a few years ago, after being dismissed as a poor man's gold for decades, silver did the unthinkable. It exploded higher by over 150% in a single year, then punched through triple digits for the first time in the metal's entire recorded history. People who had been quietly accumulating silver in their garage, their safe, their IRA, they were suddenly sitting on life-changing gains. And then came a warning. Because right now, silver has pulled back hard. From above $90 an ounce, the price has come down dramatically. We're sitting in the low 70s as I'm recording this, well off those historic highs. And social media is erupting. Forums are panicking. People who bought near the top are questioning everything. Is the silver bull market over? Was it all a speculative bubble? Should silver owners be worried? Here's what I'm going to do today. I'm going to walk you through exactly what this warning signal means, and I'm going to show you why the answer is far more nuanced and far more important than the panic brigade wants you to believe. Because this pullback is not what it looks like on the surface, and the people who understand what's actually happening underneath it are the ones who are going to be positioned correctly for what comes next. Let me take you back to something that happened in the 1970s. Not because I love history lessons, but because what happened then contains a critical piece of intelligence that applies directly to what silver owners are experiencing today. In the mid-70s, after President Nixon severed the dollar's link to gold in 1971, precious metals began a historic run. Gold had been frozen at $35 an ounce for decades under Bretton Woods. The minute that artificial ceiling was removed, it began to climb. Silver, which had been suppressed alongside gold, began to move as well. But here's what most people don't know about that era. The run wasn't straight up. It was brutal, jagged, and psychologically punishing. Silver would surge 30–40%, then correct viciously. 20–30% drawdowns that felt like the end of the world. Investors who had bought in, who understood the thesis, they would watch their gains evaporate in weeks and convince themselves they had been wrong. They sold. They walked away. And then, silver went on to reach nearly $50 an ounce by 1980, a gain of over 4,000% from its early 70s levels. The people who survived those corrections and held their positions became wealthy. The people who panicked at every pullback sold into the hands of the smart money and missed the greatest precious metals bull market in modern history. Now, I'm not here to tell you that silver is going to 50 or 150 or some other number that sounds exciting. What I am here to tell you is that the structure of this market, the fundamental architecture underneath the price, looks remarkably similar to the dynamics that drove those historic moves. And if you understand why that is, the current pullback stops looking like a disaster and starts looking like something else entirely. Let me show you what's actually happening in the silver market right now. The Silver Institute. And before you check out on me, this isn't some internet forum. This is the industry's primary research organization tracking global supply and demand. The Silver Institute has confirmed that we are on track for the 6th consecutive year of structural supply deficits in silver. Think about what that means. 6 years in a row where the world uses more silver than it mines and recycles. The projected shortfall this year alone is over 46 million troy ounces. Last year it was 40 million. The year before that it was smaller. The deficit is not shrinking, it's growing. Now pause on that for a second, because this is where conventional market thinking breaks down. Most commodities, when the price rises dramatically, trigger a supply response. Companies pour money into exploration, new mines open, production surges. The price corrects as supply catches up to demand. That's basic economics. It's how oil, copper, and most industrial metals behave over a price cycle. Silver doesn't work that way. And this is the most important thing you need to understand. Approximately 70% of all silver mined in the world is produced as a byproduct of mining other metals: lead, zinc, copper, gold. The primary miners aren't silver companies. They're companies extracting other materials, and silver just comes along for the ride. Which means when silver prices go up, most of the world's silver producers don't actually have the incentive to dramatically increase production. They're producing silver whether they want to or not, dependent entirely on the economics of the primary metal they're after. The remaining 30% that comes from dedicated silver mines, most of those projects take 7 to 10 years from discovery to production. You can't turn a silver supply shortage around quickly. Not in 2 years, not in 5 years. You're looking at a decade-long timeline to materially move the supply needle, and that's assuming companies start throwing exploration capital at the problem today. Meanwhile, demand is not slowing down, it's accelerating. Here's a statistic that should stop you cold. Solar photovoltaic applications now account for roughly 20 to 29% of total global silver demand. A decade ago, it was 11%. That single-year explosion you see represented in those numbers reflects an exponential growth curve. Solar installations are multiplying across Asia, Europe, and the Americas. Every solar panel manufactured requires silver. Not because companies are being idealistic. Silver is the most electrically conductive metal on Earth. It is physically irreplaceable in the photovoltaic cell. There is no cheap substitute that performs at the same efficiency level. Then there are electric vehicles. Each electric vehicle uses somewhere between 25 and 50 grams of silver. That's 2 to 4 times more than a conventional internal combustion engine vehicle. As global auto production shifts toward EVs, not because of ideology, but because of battery economics that are rapidly making EVs the cheaper option, silver demand from the automotive sector is projected to grow by 3 to 4% every single year through the next decade. And now there's artificial intelligence. Data centers powering AI infrastructure require enormous amounts of computing hardware. That hardware requires silver. The Silver Institute specifically called out AI-driven data center expansion as an emerging structural demand driver. This wasn't on anyone's radar 5 years ago, and it's already moving the demand needle. So put this together. You have growing industrial demand from solar, EVs, and AI. You have 6 consecutive years of structural deficits. You have a supply chain that structurally cannot respond quickly to higher prices. And you have a price that just pulled back significantly from all-time highs. That combination of factors is not what a dying market looks like. That is what a market under temporary pressure looks like before its next leg. Now, let me talk to you about something that most mainstream financial media won't touch. And I want to be careful here because I'm going to present the evidence and let you draw your own conclusions. But the evidence itself is genuinely alarming. The COMEX. For those unfamiliar, the COMEX is the commodity exchange where silver futures contracts are traded in the United States. This is the mechanism that sets the spot price of silver globally. When you look up the price of silver on any financial website, that price is derived from what's happening on the COMEX futures market. Here's the problem. The ratio of paper silver contracts, futures contracts representing silver that may not physically exist, to actual registered physical silver held in COMEX warehouses has reached levels that analysts describe as deeply stressed. We're talking about a situation where open interest in silver futures, the total number of outstanding contracts, has reached figures that dwarf the actual physical inventory available for delivery. When someone buys a silver futures contract, theoretically they could stand for delivery. They could demand actual physical silver. In normal market conditions, most traders don't do this. They roll their contracts or settle in cash, and the system works fine. The problem is that when enough traders start demanding physical delivery simultaneously, the system faces enormous stress. In January of this year, delivery requests at COMEX reached 40 million ounces. That alone was noteworthy. Senior precious metals analysts began raising red flags publicly, warning that if delivery demand continued accelerating, it could expose the fundamental tension between the paper market and the physical market in ways the system wasn't designed to handle. Now, will COMEX formally default? The rules are written in a way that allows cash settlement, meaning they can pay you in dollars instead of delivering physical silver. So a technical default, in the legal sense, is unlikely. But here's the deeper point. If a large enough cohort of silver buyers decides they want actual physical metal, not a paper claim, the pricing mechanism itself breaks down. The paper price becomes irrelevant. Physical silver begins to trade at a premium that increasingly disconnects from the official exchange price. And here's where something fascinating enters the picture. There are analysts who believe China has been systematically positioning itself to exploit exactly this dynamic. China is the world's largest silver consumer. China has been aggressively moving precious metals, positioning in ways that increase strain on Western pricing systems. The theory, and I want to be clear, this is a theory, not a proven fact, is that China, in the context of broader de-dollarization, has strategic interest in demonstrating that Western commodity exchanges are pricing silver at a discount to its true physical value. Whether or not that specific theory is right, the broader context is absolutely real. BRICS nations have been loudly and explicitly discussing alternatives to dollar-denominated commodity pricing for years now. Gold buying by central banks has been running at historic rates. The dollar's share of global reserve assets has been declining, slowly but measurably, for over 2 decades. The financial architecture built after World War II, Bretton Woods, the petrodollar, the IMF system, is under more coordinated geopolitical pressure than at any point since the 1970s. And the last time that happened, silver went on a run that nobody who missed it ever forgot. Before I get to where I think this market goes from here, and I want to walk you through the specific technical and fundamental case, real quick, if you're watching this and you're in or approaching retirement, I've put together a free guide in the description below that breaks down the specific strategies that thousands of American retirees are quietly using to protect their savings in this environment. It walks through the options, the mechanics, and what the most financially savvy people are actually doing right now versus what they're saying on television. Check it out. The link is right in the description. Now, back to the warning. Here's the thing about warnings. A warning can mean two completely different things depending on who you are and what position you're in. If you hold silver and you're watching the price pull back from $100 to $70, the warning might be careful. Volatility has increased, and the speculative frenzy that drove prices to an all-time high in January was not purely fundamentals driven. That's a real warning. Silver did attract enormous speculative interest at the peak. Retail investors flooded in when the price was already up 40% on the year. Social media was full of silver price targets that sounded more like wish lists than analysis. When that kind of speculative heat builds up in any market, a correction is not just possible, it is inevitable. The market needs to shake out the weak hands before the next genuine move higher can be sustained. This is how markets work. This is how they have always worked. The 1980 silver peak is instructive here too. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, famously tried to corner the silver market. They accumulated over 100 million troy ounces of physical silver. The price rocketed to nearly $50 an ounce, which in today's dollars is well over $150. And then it collapsed. When regulators changed the margin rules and forced the Hunts to liquidate, silver crashed back to single digits. People who had bought at the peak, chasing momentum, were devastated. But here's what the story doesn't end there. The silver price decline after the Hunt brothers' collapse had nothing to do with the underlying industrial fundamentals of silver. It was a forced liquidation driven by regulatory intervention. Silver spent the next quarter century trading in a range that many analysts believe was significantly below its fair value. The manipulation wasn't that the price went up, it's arguably that it was kept artificially suppressed for decades afterward. And then in 2008, something interesting happened. Silver, like virtually every asset on Earth, crashed during the financial crisis. It fell from around $20 an ounce to under $9. The headlines were brutal. The economy was melting. Bear Stearns had collapsed. Lehman Brothers had just failed. Silver felt like a terrible place to be. But look at what happened next. From that low of $8 or $9 in late 2008, silver began climbing and climbing and climbing. By 2011, silver had reached nearly $50 an ounce, the same level the Hunts had hit in 1980, briefly touched in nominal terms. People who had bought during the 2008 panic sold at the bottom and missed a 500% run. The pattern repeats. The metal gets volatile, weak hands sell, smart money accumulates. And the people who understood the fundamental case, the supply deficit, the industrial demand, the monetary backdrop, those people collected the wealth that the panicking sellers left on the table. Now, let me bring this right back to today's specific warning. What we're watching right now is a market that ran from roughly $40 to over $100 in about 18 months. It attracted enormous retail attention and speculative capital at the peak, and now it's digesting those gains. The gold to silver ratio has moved from the extreme lows we saw during the silver peak. Technically, the price is below key moving averages. The narrative in financial media has shifted from breathless enthusiasm to quiet concern. Here is what hasn't changed. The supply deficit is still there, and it's getting worse, not better. Industrial demand from solar, EVs, and AI continues to grow. Central banks are still buying gold at near record rates, and that gold accumulation historically correlates with precious metals broadly moving higher. The geopolitical stress that's been driving safe haven demand, currency tensions, trade disputes, NATO pressures, hasn't resolved. If anything, the world is more fragmented and uncertain today than it was 3 years ago. And here's the number that should command your attention regardless of where you stand on silver. JP Morgan Research, not some obscure newsletter, not a YouTube channel, but one of the most significant financial institutions in the world, has publicly forecasted silver to average around $81 an ounce for the full year. That is above current prices. That's not a fringe view. That's Wall Street's analytical arm saying the current price represents a discount to fair value for the year. Separately, technical analysts who focus specifically on silver's price structure are identifying what they describe as a digestion phase, a healthy retracement following a major advance. Their near-term targets for a rebound sit in the $120 to $130 range, contingent on silver holding its current support levels. The gold to silver ratio, sitting around 60, is not at extreme levels historically. It has plenty of room to compress further, which would mean silver outperforming gold on a percentage basis, as it has historically done in the late stages of precious metals bull markets. Let me explain what that ratio compression means, because it matters enormously for how you should think about your positioning. When gold and silver both move in a bull market, silver historically moves faster and further on a percentage basis. It's a more volatile, smaller market. Think about it like the difference between moving a large ship and a speedboat. Gold is the ship, slow and steady, while silver is the speedboat that can cover ground quickly when the currents shift in its favor. When the gold-silver ratio falls from, say, 80 or 90 down toward 50 or 40, that compression represents silver dramatically outperforming gold. We've already seen that compression happen once in this cycle, silver going from dramatically undervalued relative to gold to reaching a ratio that reflected more appropriate historical norms. But history shows that in the strongest precious metals bull markets, the ratio often goes much further. In 1980, it went below 15, meaning silver traded at a value equivalent to 1/15 of an ounce of gold. Today, with gold where it is, a ratio of 15 would imply silver prices that would seem absolutely staggering to most people watching this video. I'm not predicting that happens. What I am saying is that the mathematics of ratio compression, which is historically well documented, suggests significant upside potential remains in silver, even after the remarkable run it has already had. Now, what does all of this mean for you if you actually own silver today? The warning that silver owners just received is a warning about volatility, not a warning about the underlying investment thesis. These are very different things. Volatility is uncomfortable. It tests conviction. It shakes out people who bought for the wrong reasons, who bought because a price chart looked exciting, rather than because they understood the supply-demand dynamics, the monetary backdrop, and the geopolitical context. If you are sitting on silver that you bought because you understood those things, because you recognized that 6 consecutive years of supply deficits in an industrially essential metal against a backdrop of global dollar hegemony declining and central banks accumulating hard assets at unprecedented rates creates a structural investment case, then the current pullback is not a warning to panic. It is a shakeout. It is the market doing what it always does before a major sustained move, testing conviction, reducing speculative excess, and resetting the emotional temperature. If you were sitting on silver that you bought near the $100 peak because everyone on the internet was talking about it and you had serious FOMO, then yes, the warning is more pointed for you. Not because the metal itself is broken, but because your entry point and your motivations matter enormously in determining how well you weather the volatility that is a feature, not a bug of this asset. Here's what the sophisticated money appears to be doing. According to market positioning data and fund flow information, institutional buyers used the recent correction to add to physical metal exposure. The ETF redemptions that accompanied the price decline were primarily retail-driven, while smart institutional money was quietly positioning on the other side of that panic selling. This is not unusual. This is the pattern that repeats itself across every major commodity bull market in history. Physical silver continues to move off dealer shelves at elevated premiums. There are stretches where retail silver products, American Eagles, Maples, generic rounds, are commanding premiums above spot price that reflect actual scarcity of physical product at the retail level, even as the paper price fluctuates. That divergence between paper price and physical reality is one of the signals that sophisticated precious metals observers watch carefully, because it's an indicator of genuine supply tightness at the physical delivery level. The warning, then, is this: the silver market is entering what could be a period of extraordinary volatility in both directions. The structural case has never been stronger. The supply deficit is confirmed and growing. Industrial demand is accelerating across multiple technology vectors simultaneously. The monetary backdrop, dollar pressure, geopolitical fragmentation, central bank gold accumulation, is arguably the most supportive it has been in 50 years. But these forces are colliding with a market that attracted significant speculative excess at the peak, a COMEX system under growing physical delivery pressure, and a global macro environment full of risks that could trigger risk-off selling across all assets, including precious metals. What that means practically is that the path higher for silver, and based on the fundamentals I've laid out, the case for higher is genuinely compelling, will not be a straight line. It will be exactly what we're watching right now: violent moves up, violent corrections, narratives that shift week to week, and the psychological challenge of holding conviction through the noise. History is clear about who wins in that environment. Not the person who tries to time every twist, not the person who sells in panic at every pullback. The person who wins is the one who understood why they owned the asset in the first place, who had a position size they could live with through volatility, and who stayed focused on the fundamental story rather than the daily price action. Now, I want to spend a moment on what this environment specifically means for people who are in or approaching retirement, because the conversation around precious metals has to be different for someone in their 60s who is protecting accumulated wealth than for someone in their 30s who is building it. When you're in retirement or approaching it, you have one primary financial concern above all others: preservation of purchasing power. You have built your nest egg. You have done the work. And the last thing you can afford is to have the value of that nest egg eroded by the forces that are clearly in motion right now. Think about what we've described: a dollar that is losing reserve currency dominance, slowly but measurably; deficit spending by governments that shows no signs of reversing; structural debt levels that historically have only been resolved through inflation; a geopolitical landscape that is fragmenting global trade and creating price pressures across essential goods; bond markets that have struggled to provide the safe, reliable income that retirees depend on; equity markets that are at historical valuation extremes by multiple metrics, even after recent volatility. Against that backdrop, silver, and precious metals broadly, have historically served as a form of monetary insurance. Not a speculation, not a trade, insurance. The role of silver and gold in a retirement portfolio isn't to replace your stocks and bonds. It's to provide a hedge against the specific risks that those paper assets cannot protect you from: currency debasement, systemic financial stress, and geopolitical disruption. And here's something that many people sitting on retirement accounts simply don't know. There are legal, IRS-approved structures that allow you to hold physical precious metals, actual silver and gold bars and coins, in IRS-approved storage inside a retirement account, an IRA, tax-advantaged. You get the protective characteristics of physical precious metals combined with the tax benefits of a retirement account structure. It's not complicated, it's not exotic, but it's also not something most financial advisors lead with, because most financial advisors are compensated based on the paper assets they sell. If you have $100,000 or more in any retirement account, whether it's a traditional IRA, a 401k, a 403b, whatever structure you're using, and you want to understand how this specifically works, I've put together a detailed guide on exactly this topic: how gold and silver IRAs function, what the rules are, what the legitimate benefits and the real limitations are, and how to evaluate whether it makes sense for your specific situation. No obligation, no pressure, just the education. The link is in the description below. Now, back to the silver warning and what comes next. The technical picture for silver right now, sitting in the low 70s after touching triple digits earlier this year, presents a classic compression setup. The metal found significant support at levels that correspond to prior breakout zones. Volume patterns during the decline suggest the selling was largely concentrated in speculative paper positions rather than liquidation of physical holdings. The gold-silver ratio, while it has expanded during the correction, remains at historically favorable levels for silver relative to what it was 3 years ago. Multiple institutional forecasters, JP Morgan at $81 average, technical analysts targeting 120 on the next move, are not calling for silver to collapse back to where it was. The consensus view among serious analysts is that this correction is a buying opportunity, not a trend reversal. And layered underneath all of it is the structural supply story that doesn't change based on price action. The deficit is baked in. The industrial demand growth from solar and EVs is baked in. The monetary pressure from global de-dollarization is a multi-decade trend. These are not things that a price correction resolves. They are tectonic forces that continue building pressure beneath the surface. And price corrections are the temporary release valve, not the end of the story. Think about what 6 consecutive years of deficit means in cumulative terms. Every year where the world uses more silver than it produces, it draws down from existing above-ground stockpiles. Those stockpiles are finite. Global above-ground investable silver inventories have been declining. The buffer that exists between current demand and supply is shrinking. At some point, and smart money analysts are debating the timing, not the direction, the math of a structural deficit in an industrially critical metal catches up with the market in a way that cannot be managed through paper price suppression or speculative liquidation.